Now, why would you go buy Treasuries and the high yield market at the same time?
Well, you got to remember, they both have positive returns to them. They both have a coupon. They both roll down the yield curve. So in periods of low volatility, we don't have a lot of price action. You will tend to get some slight positive correlations, but normally they are negatively correlated. That's why putting them together in a portfolio is so valuable.
So how tight can credit spreads really get? I mean, in Europe in particular, I mean, European equities are now yielding more than junk bonds. I mean, what's going to make them widen at this point?
Well, history would suggest that you can remain at very, very tight levels for a long period of time. And you would have said the same thing in 2005 already. And then even in 2010, before the European debt crisis, spreads get to very tight levels, people get complacent, and then something happens. That something is always hard to predict.
Gershon, Morgan Stanley's out with a note saying we're late in the credit cycle, particularly in the United States. And as a result, you should stay away from high yield and go to investment grade. Do you disagree?
So, look, we've been saying we've been late in the credit cycle for 3 years now. I keep on hearing 7.
It's going to turn sometime.
Fair enough.
So, look, if your time horizon is very short, then I think, yeah, it's a little bit dangerous right now. But, given the low-level yields overall, given the positive carry in some of these risk markets, it's pretty expensive. And I think the odds of sitting on the sidelines and putting your money in the bank, the odds of that beating high yield over, let's say, a year period is very low.
But is the credit risk going up, and are you getting paid for it on high yield?
So high yield is a lot of different markets. I mean, certainly there are parts that are stresses, retail and healthcare. Overall, a large part of the market's actually in pretty good shape. So spreads are tight, yields are low. That just means you're going to earn lower returns, and that doesn't necessarily mean you're going to blow up.
But what part of this is technical? Because we've seen the lowest issuance for high yield since 2012, right, so far? So how much of this is a technical play? Well,
certainly there's a bid for income all over the world, particularly from Asia. So we are still seeing strong flows from many investors, and that's going to continue until something happens. So technicals are good both from a demand perspective, and you're right, there isn't a tremendous amount of supply because anyone who's needed to issue has basically issued over the past couple of years.
I should point out that Hertz this week had to increase its issuance because there was just so much demand. What they had, it was crazy. So just to the point, there's just not a lot out there.
Well, but to the point, the fact that a lot of people want to buy it doesn't mean it's necessarily worth that. It can really drive up valuations to an unreasonable level, Gershon.
Well, to the point, Hertz didn't have to increase it. They were able to increase it. In fact, that's actually what's going on in the floating rate bank loan market, where everyone is so enamored by this floating rate. We know rates are going to rise. I want to be in floating rate debt. But that's allowing issuers who really should be coming to the high yield market and paying 8, 9, 10% to issue in that floating rate market. People are taking on a lot more credit risk than people think.